the S&P within striking distance of reaching all-time highs. And on Wednesday, the bull market will turn 3,453 days old. Happy birthday. The longest bull market in history. So will the good times continue? Jeff Carbone is co-founder and managing partner with Cornerstone Financial Partners. Jason Ware is chief investment officer with Albion Financial Group. Jason, what do you think? Can the market continue to just rally ho?
You know, I'm not smart enough to tell you whether or not over the short run the market's going to continue to move higher. It should continue to move higher given the fundamentals that we see out there, which is a strong economy, even stronger earnings growth, low inflation, low interest rates, and a valuation that's still not terribly demanding on the market. So, you know, I mean, the trend is still higher. The longer term trend is still higher. So take from that what you will. Over the short run, there's probably going to be some volatility and some pullbacks to be had, but we still like the longer term picture of the market given the fundamentals.
What's the biggest risk you've got your eye on, Jeff?
Yeah, I think right now it's the headline risk of trade. I call it the 4 T's. It's been about trade, tariffs, Tesla, and Turkey. But just right now, I think it's about the E's, which is earnings have been coming really great. We've had a tremendous earnings season as we wind down. Year over year, about a 10% movement, which is probably the best since 2011. About a 25% increase for the quarter, about 20% higher than analysts expected. So we're seeing earnings in great order, and then we're seeing the economic data continuing to come in strong. Unemployment below expectations at 3.9. GDP, we can continue to go through all the positives. So when I look at the risk, I guess it's really watching what's coming up right now, and that would be certainly interest rates and from the Fed coming in September, and midterm elections not too far behind. But I think overall there's enough strength in the economy for it to keep moving along pretty nicely.
So, Jason, you sound very positive, but do you just throw your money at the S&P 500? You just buy an ETF, or are there certain sectors that are going to outperform considering your viewpoint of where the economy is going?
No, it's a great question, and it requires a lot of nuance, unfortunately, right? I mean, it depends on the investor. If you're a young investor and you have a 30-year horizon or more and you're just starting to invest, it probably makes sense to go ahead and just buy the S&P and low-cost index. If you're an investor that has more of a complex financial situation and you have certain requirements, whether it's dividend income or whether you want to protect the portfolio a bit from downside volatility with some fixed income and some safer areas of the market, then that would warrant, you know, a different orientation. We still like technology. We still like wide moat, strong cash flow technology names like Facebook and Amazon and Apple and Alphabet. Meanwhile, we think the consumers still continue to be strong. So, you know, Costco and Home Depot are a couple of stocks that we're looking to build solid portfolios with.
Jeff, your thoughts on that? I mean, where would you be putting your money right now? Is the U.S. still the best house on the block, or would you be looking overseas?
You know, I think it's balancing in a diversified portfolio is certainly what we preach to our clients. Right now, we have been de-risking a little bit in the portfolio. Not that we think the volatility may increase a little bit here as we go in the end of August, September, October timeframe, but still finding plenty of great opportunities in technology.
What does de-risk mean? Does that mean you raise cash, or you buy defensive stocks instead of, or value stocks instead of growth stocks?
Yep, great question. I think it's for us right now. It's the de-risking is buying more value stocks like some consumer staples, selective on consumer staples, because certainly not one of the better performing sectors this year. But when we look at some valuations on some of the consumer staple areas, some of the food groups we've really found some really good valuations, some nice dividends. So de-risking a little bit more on the large value side, but still realizing we're in a growth economy, so technology with semiconductors, financials, materials and industrials, and as well as consumer discretionary are still some of the bigger overweights we have right now.
So, Jason, let's talk a little bit of Turkey here. How big a worry is it? And it feels to me personally that this is a movie in part that we've seen before. In other words, an economy under distress with currency issues at play, and then you look at Italy and their economy, and certainly after the bridge collapse last week, people are angry at the government there and the end of the Greek bailout. Are these things taken together or separately, things that are on your radar screen at all?
Yeah, I mean, these are things that we pay attention to, obviously, as active managers. But we think the risk from Turkey spreading into some kind of contagion situation that ends up impacting the U.S. economy and by extension impacting the U.S. stock market is fairly low risk. We do think that we've obviously seen a protracted bull market here, and we think that the likelihood that anything outside of an economic recession ending the bull market is pretty small. So unless that contagion from Turkey were to spread into the U.S. economy, we don't think it's a big risk for now.